Most roofing companies operate under a dangerous assumption. They believe they know their numbers, but in reality, they only know their revenue. Measuring a company's operational health solely by its sales volume creates a false sense of security. Top-line revenue looks impressive on paper, but it tells you nothing about the actual cost required to execute the work. This represents a standard roofing contract as a solid block of gross revenue. Let's say a company sells a roof for $25,000. But without isolated job costing, this top-line metric masks severe financial instability beneath the surface. Equating gross sales with actual business health is an operational trap. It hides the true physical and logistical costs of the build until the margin has already evaporated. Roofing companies rarely go bankrupt because they cannot sell enough roofs. They fail from a complete lack of operational control. They bring capital in but bleed it out immediately because they cannot track where it goes. Survival requires mastering unit economics. This means isolating and rigorously tracking every single profitability variable on a project-by-project basis. While the industry focuses on macro growth and total sales volume, operational health dictates mathematical certainty at the micro level. Operators must maintain a granular understanding of every component on every job site. This micro-level tracking provides the data necessary to identify whether a company is actually growing or simply increasing its rate of loss as it scales. This waterfall chart breaks down the $25,000 contract. The first erosion happens between the estimate and the supply house. Routine discrepancies between estimated and actual material costs shrink available profit. Then comes the physical installation. Unpredictable weather, complex tear-offs, and delays cause labor overruns. Operations also absorb the unbudgeted friction of extra accessories, missing from the original order but necessary to complete the roof. Finally, post-production callbacks consume what margin is left. A structural failure aggressively compounds labor and material losses on a job already marked as completed. These physical production realities degrade theoretical gross profit before a single administrative cost is factored into the ledger. The remaining primary block now faces hidden administrative and logistical costs that silently drain the balance sheet. Delayed insurance supplements create immediate cash flow bottlenecks, functioning as a heavy operational tax. Next comes the risk of paying out sales commissions based on gross revenue. Distributing cash on a $25,000 top line rather than the actual net margin means distributing cash the company doesn't possess. Profit is further eroded by logistical miscalculations when dumpsters exceed assigned weight budgets. Finally, municipal permit fees and unexpected regulatory compliance costs take the last cut, resolving to a tiny actual net margin. When operational reality hits, a project that appeared profitable at the point of sale can mathematically result in zero net margin, or even a loss. The mathematical accuracy of this margin bleed is only half the equation. The timing of financial information determines whether you can actually stop it. The traditional method relies on end-of-the-month spreadsheet reconciliation to determine overall company profitability. The flaw here is time. Waiting 30 days to understand job costs means acting on expired intelligence, ensuring the financial damage is already irreversible. Relying on a monthly look-back ensures operational paralysis. It strips leadership of the ability to course-correct while the project is in motion. The direct solution to data latency is the real-time integrated tracking of every variable on every single project. This analytical matrix visualizes the power of unit economics. Tracking at this level allows operators to isolate and evaluate which specific sales reps are profitable based on their net margin rather than gross revenue. This system also identifies which production crews generate the highest frequency of margin-killing callbacks. Additionally, mapping margin data to geography reveals which specific neighborhoods consistently yield the best returns. Analyzing these combined metrics reveals exactly which specific job types create the most reliable, positive cash flow for the business. Real-time job costing provides the exact visibility required for surgical resource allocation, replacing reactive management with predictive control across the entire enterprise. Standard industry practices fail to achieve this level of predictive visibility. This architecture diagram illustrates the structural flaw in modern contracting. Businesses rely on isolated software nodes and manual spreadsheet tracking. Operational friction occurs when sales, production, and accounting teams operate blindly within these fragmented data silos. A disconnected data architecture acts as a margin sieve. As a company attempts to scale its sales volume, the structural breaks in communication create exponentially multiplying errors. To survive today, the technological standard for top-tier roofing contractors requires transitioning to a fully integrated, unified workflow. Looking back at our systems map, this architecture forces sales, production, purchase orders, and invoices out of isolation and into one unified data pipeline. Inside a unified system, profitability updates synchronously in real time. This eliminates data latency entirely and creates a continuous, unbroken chain of communication that provides immediate truth to operators. A low-level operation measures success by the volume of contracts acquired. A high-level enterprise measures success by the execution of controlled, profitable scale. The objective of a professional contracting business is the protection of margin throughout the lifecycle of the scale.